Amy Goodman. The worst of the economic crisis may be far from over. That was the message of Federal Reserve Chair Ben Bernanke Tuesday. He indicated the housing and financial turmoil will persist deep into next year. The Senate, meanwhile, is deliberating a bill this week that would provide government-backed loans to 400,000 homeowners on the brink of foreclosure. The housing bill has faced some resistance from Republican lawmakers and was also threatened with a White House veto, but is expected to pass the Senate. With skyrocketing foreclosure rates, critics say the measure is expected to only help a small percentage of the estimated 3 million homeowners threatened with foreclosure. The Washington Post also reported last month the bill's key provisions were suggested to Congress by lobbyists for major banks like Credit Suisse and Bank of America, banks that are facing huge losses from the subprime mortgage crisis. The nation's top housing official, Steve Preston, warned Tuesday that the legislation could overwhelm the Federal Housing Administration with risky loans. To discuss the state of the economy, I'm joined now by two guests. Nomi Prins is former investment banker turned journalist. She used to run the European Analytics Group at Bear Stearns, now a senior fellow at Demos. She's the author of two books, Other People's Money, The Corporate Mugging of America, and Jacked, How Conservatives Are Picking Your Pocket. Nomi Prins is here in the Firehouse studio. We're also joined on the phone from Washington, D.C. by David Korn, D.C. bureau chief of Mother Jones. His article in the latest issue of the magazine is called Foreclosure Phil. We'll find out who that is in just one second. Nomi Prins, what are the 5 ways that Washington and Wall Street has brought us to this crisis?
Well, it's a historical matter, and basically there's been a lot of legislation that has weakened the regulation of the housing industry and the lending industry and the trading that takes place with it that Wall Street has enacted and has gotten us into this major credit mess. It really goes back to the 90s. There was an act passed in 1994 that was trying to actually help homeowners get protection from abusive lending. In other words, lending at a very high interest rate. And it was passed and it was advocated by consumer advocates, and it had aspects of being a good bill. However, what it did was cap them after a certain rate, after a 12.5% rate, after a certain rate over treasuries. And it didn't cap all of the abuses that could happen in between. So what it did, in fact, was create the beginning of the subprime situation where lenders could say, all right, we don't want to come under this regulation. It's called the HOPA law, H-O-E-P-A, the Homeowners Equity Protection Act of 1994. Lenders said, all right, you know what, we won't come in there at the high rates. We don't want to get under on the radar screen in that respect. We'll just come right under. And we'll start to look for ways to make loans with lots of bells and whistles and lots of fees attached to them, where we can come under the radar screen and start to create this kind of market of potential problems. Now, we didn't know these problems were happening in the 90s. That was one issue. They didn't start to happen until the market started to fall apart after the boom of the 90s, the bust that occurred in 2001, 2002, because of a lot of corporate scandals and other measures that were happening in the world and in the U.S. economy in particular. And since then, we've had a fallout. But the seeds were placed in the 90s. The second thing that happened also in the 90s, in 94, was the Truth in Lending Act, which was a 1968 original act. It was put together to create a situation where lenders had to disclose, and not only disclose all of their potential alarms that could go off within a loan to a prospective borrower, they had to also be accountable. And that's a situation we've come a long ways away from, is the accountability of lenders, that they could actually be brought to court, be brought to trial, be brought to be accountable for hidden problems in their loans. In 1994, that Truth in Lending Act was amended. And it was amended because there started to be a lot of lawsuits, starting in Florida and then flowing through the United States, which basically said, you know what, if lenders go outside of their responsibilities, they can be sued. They can have to pay out. They can lose certain amounts of money that they have counted on. And the lenders were like, you know, we don't like that. We don't like to be accountable for what we're doing. So they lobbied for the amendments, and that happened in the 90s.
Well, let's go then to the campaign advisor to John McCain, Phil Gramm, the former Texas senator. David Korn, can you talk about his significance today and in the past in this crisis?
Well, yes. I mean, Nomi gave us a great introduction, and it's a pleasure to be on a show with such an informed and intelligent voice on these matters, which often are quite complicated. But another part of the history that has led to the subprime crisis involves a sly backroom legislative maneuver mounted by Phil Gramm, who was Republican chairman of the Senate Banking Committee in the 90s, and this happened actually in the end of the year 2000, and who today is a leading advisor to John McCain, co-chairman of his campaign, and mentioned as a possible Treasury Secretary should John McCain win the presidency. And what happened in 2000 was it was a painful period for some of us. It was the week that the Supreme Court was giving the election to George W. Bush. As often happens in Washington, Congress had yet to pass most of the appropriation measures that it needed to before that Congress coming to a close. And so they were lumping together, 6, 7 different appropriation bills into one mega bill, working all hours of the day, and no one really understanding what was and wasn't in the bill that they had to pass to keep the government going, and most people being distracted by the ongoing fight between George W. Bush and Al Gore in the Supreme Court. And in the midst of all that chaos, Senator Phil Gramm slipped into this must-pass spending bill, a 268-page bill, the Commodities Futures Modernization Act, which had been kicking around for about a year. The House had passed one version of it, but there were a lot of different versions of it, and the point of it was to do a lot of different types of deregulation. It included something called the Enron loophole, which allowed Enron to sell energy futures on a deregulated basis, which helped lead to the California energy crisis the following year and the subsequent collapse of Enron. But another portion of the bill deregulated these financial instruments called swaps. And one reason I understand this is because Nomi explained it to me some time ago. These are instruments that are created by investment houses and securities firms, and they're basically bets that cover their investments. If they get them from another firm, so if an investment they have is going to go south, going to tank, they can collect on this so-called insurance policy from somebody else. The problem is that these swaps, thanks to Phil Gramm's bill, are totally unregulated. And the swap market is something like now about 4 times the size of Wall Street in terms of securities that are regulated. And it really turned a lot of the economy into a secret casino. All this action going back and forth, people betting on bets. They would, and how this related to the subprime crisis is about this same time, security firms started bundling all these bad or risky mortgages and securitizing them, and then they would sell these securities or buy them and then buy swaps or sell swaps to cover the possible loss. So it really enabled a lot of firms to go hog wild on the subprime stuff, and the brokers who were doing this have no worry about losing because they were passing on the possible risks of loss to somebody else who never really had to have the assets to cover those losses. It was, and this is all sort of taking place off the books. When UBS, which is the biggest Swiss banking company, lost, I don't know, I forget the number now, $38 billion or so in the subprime crisis, it put out an internal report for public consumption explaining how this had happened. And they noted that it had happened in part because the securities that they lost money on connected to these subprime loans had been backed by their trading in swaps. So here they were saying we were able to do this because of these unregulated swaps, which some people at this Commodity Futures Trading Commission had wanted to regulate. And it were the lobbyists who went to, the financial industry lobbyists who went to Phil Gramm and said, listen, we got to have these swaps unregulated. They convinced Larry Summers, who was Treasury Secretary. They convinced Alan Greenspan. And even though the bill was pronounced dead weeks before Phil Gramm did anything, he still managed to slip it through, get it passed by Congress when no one was looking, and no one even read it. no one knew what was in this bill, and then the swap market took off, which helped lead to the subprime crisis. And so you think that a guy who did that and also gave us the Enron loophole would now be persona non grata in Washington and in the world of high finance. Well, if you thought that, you'd be wrong, because Phil Gramm went on to become a lobbyist and a high-paid executive at UBS, that same Swiss banking firm that lost tens of billions of dollars on the subprime crisis. And as I mentioned earlier, he's in line now for a high position in a McCain administration. So, you talk about failing upwards. Phil Gramm is a great example of the market not working. Somebody who has failed so grandly as Phil Gramm should be driven out of the market. He should be a